And I think you can just look at this year as a prime example. The dollar's down 10% and gold's up 38%. So you're talking almost a 50% swing. And if the state were to have been holding its reserves in gold, it would be far, far, far better off from a standpoint of purchasing power than it would be just holding it in dollars. All fiat currencies are inherently meant to die, and the policies of this current administration center around a weakening dollar and lowered interest rates, which is inflationary. This is why the smartest money in the world has been accumulating gold hand over fist, that being the central banks. And I would add into it somewhere in the neighborhood of 100 billion with the B dollars that we know of, and I would argue there's probably a lot more that isn't reported, has been delivered into the COMEX market since November. And you're talking the most well-informed, the most well-funded, and the most sophisticated traders on the planet. Now, who is doing this? Who's got those pockets? And so, yeah, I think that there is no question at the highest level, and the only ones who would vote against that would be the banks, because it takes away, obviously, much of their power and leverage, as they've already seen a mass exodus of deposits leave the banking system chasing yield to treasuries. I'm sure the last thing they want is to see legal tender in gold, which would be a far, far, far more sound way of holding your wealth. And, you know, people get too focused on return or yield. There is no yield on gold, obviously, and they focus too much on that. But if you look at its performance over the last 25 years, it's doubled the performance of the 10-year treasury. So it doesn't need yield attached to it, because inherently what it does is it maintains your purchasing power. It sniffs out the stealth monetization or the stealth inflation that is inherent to the system and continues to move higher. Whether you look at last year, gold was up 40%, the 10-year treasury up 4.5%, or this year, the 10-year treasury up 2.5% halfway through the year, but the dollar down 10, you're negative 7% in the hole plus, yet gold's up 38%. So when you talk about allowing the constituents the ability to get out of the way of irresponsible fiscal policy and arguably brain-dead monetary policy, it would be the best thing in the world for the constituents. Jason, am I wrong in saying that it was a unanimous bipartisan vote in Utah, but for whatever reason, the governor vetoed for the first time a unanimous bipartisan agreement? Am I wrong in saying that?
So it was unanimous, I think, in the House, and I think nearly unanimous in the Senate. And it's certainly certainly of his own party, the Republicans, was unanimous. And I don't think that's ever happened before.
Is reasoning in that case when you have the entire will of the people and the majority of the legislature saying, yeah, let's do this. The state feels it's smart enough to add 100 million into its coffers. Yeah, I mean, what you are doing, Jason, not only in building a wonderful business, but also in really representing sound money, and in many respects, the United States, the will of the people with the legislature is fantastic. And it's a growing trend that I think will continue to manifest. You're seeing it here in Florida. I spent time with some of the people in the economic war room yesterday on the phone going over all of this. And I think really this is a grassroots movement that is gaining momentum, certainly around the country. So it's exciting to see, and let's hope it gains some more traction. And rumors that I hear, and I won't substantiate them, but rumors that I hear is that there is actually a good chance, and someone that I would love to talk to, and certainly, Adam, you may want to try and get him on your show as well, as Representative Alex Mooney from West Virginia, who has passed these or tried to float these bills federally to remove capital gains taxes and to call gold, especially that gold that would be issued by the U.S. Treasury, the Eagles, money, and rightfully so. And for these bankers who claim it's unconstitutional, actually, they're wrong. The Constitution says it is treasonous to use any money that is not species, which is gold or silver. So it's, as usual, the bankers are self-serving and wrong. And guys like Alex Mooney, guys like you, Jason, and others who would much rather hold their money in something sound and stable. And let's not forget the overreaching risk that we see in an undercapitalized, over-leveraged banking system that obviously doesn't want to see more of their deposits leave. But why would you leave your money in a banking system and in a currency that's being inflated, a banking system that's leveraged and undercapitalized and teetering and has bail-in legislation. I mean, it all seems that we're getting to that point. So yeah, I let's all hope. And this may sound corny, but hey, I suppose if you are in any of these states where they're considering it, and Jason, is there a spot to go to so people can see what states are considering this legislation? Because a simple contacting your legislature probably is a good idea if we are in any of these states where it is currently under, I guess you could say, review, or if it's in some sort of a what would it be, a panel or a council determining whether it's right for the state or not.
Let's start by stating the obvious. The dollar is not what it used to be. And the most dangerous thing about that isn't just the erosion of your purchasing power. It's the way that erosion is being deliberately engineered, then masked, then repackaged as economic strategy. Now I get it. Most people don't have time to dig into monetary theory between commutes, bills, and trying to survive another election cycle. But this stuff matters. It's the core of everything. And once you realize what's really happening to your money, it changes the way you see the world. You don't need to be an economist to understand this. You just need to ask a simple question. If the US dollar is so strong, why is everything so expensive? Why does a trip to the grocery store feel like a mugging in broad daylight? Why is it that over the last 2 years, your income might have gone up 5%, but your cost of living has jumped 20%? The answer is baked into the very structure of fiat currency. It's meant to lose value. And when you combine that with an administration that wants lower interest rates and a weaker dollar to juice the debt markets, what you get is the slow suffocation of the middle class. And yet, central banks know exactly what's happening. That's why they're buying gold at a pace we haven't seen since the Bretton Woods system collapsed. Let me say that again. The central banks, the most informed, best capitalized institutions on earth, are snapping up gold like it's going out of style. Why? Because they know the end game. They know that when a currency's credibility starts to erode, the smart move is to diversify into something that has outlived every fiat system ever created. Gold doesn't need a board meeting. It doesn't need a bailout. It doesn't need QE. It just is. I want to share something that's been on my mind lately. We talk a lot about the performance of gold, and yes, it's up 40% this past year while the dollar's down 10%. That's a massive swing, almost 50% in real terms. But what people often overlook is that gold doesn't pay yield. It doesn't offer interest. And yet, over the past 25 years, it has doubled the performance of the 10-year treasury. Think about that. The so-called risk-free asset has been completely outperformed by a chunk of metal that sits in a vault and does absolutely nothing, except preserve your wealth. And there lies the rub. Gold doesn't have to do anything flashy. It just has to not go to zero. In a world where banks are over-leveraged, governments are overextended, and currencies are overprinted, that alone makes it revolutionary. Now let's bring it home. We've seen multiple states in the US now beginning to challenge the fiat monopoly. Utah, for example, proposed a law that would have allowed for gold-backed reserves, and it passed with overwhelming bipartisan support. That's right, bipartisan support in this day and age, which is like finding a unicorn playing poker with Bigfoot, and yet the governor vetoed it. Why? Well, that's the billion-dollar question. What does it say when the collective will of the people and their elected representatives is overruled to protect a financial system that's demonstrably failing? It tells me we're on to something. This isn't just about fiscal responsibility anymore. It's about reclaiming agency. It's about saying, I don't want my financial future tied to an IOU from a government that prints $1 trillion every time it stubs its toe. And honestly, it's about dignity. When the monetary system works against you, when your savings are penalized, when your work is devalued, what you're left with is a society of discouraged, disoriented citizens who no longer trust the system. And who can blame them? And then you have gold. No clickbait, no flash, no quarterly earnings calls, just quiet, steady value. I always say gold doesn't promise returns. It promises survival. And in the world we're heading into, survival might be the greatest return of all. Let's look at the political implications. The backlash against the current monetary regime isn't just academic anymore. It's becoming political. It's becoming emotional. People are starting to feel the weight of inflation, not just read about it in Fed statements. They see their rent go up, their groceries spike, their utility bills stretch their paychecks, and no amount of cheerful GDP statistics or stock market rallies can hide the reality of that. In that environment, gold doesn't just look attractive, it looks honest. Now let's be clear, the banks hate this trend. They don't want you to hold physical gold. They want you inside their system, where your assets are digits they control, loans they monetize, liabilities they repackage. You holding gold? That's a problem. That's money they can't leverage. And when states start talking about holding it in reserve, it becomes existential. The very idea of a decentralized asset base threatens everything the banking system is built on.
I've been sitting on my hand. I will say that I have devil's advocate in terms of perhaps the way the federal government looks at it. And I want to bring into focus Judy Shelton's argument of issuing 50-year treasuries. Mm-hmm. Because as we said earlier, we have that $37 trillion debt, but the unfunded liabilities, Jason's point, in Medicare, Medicaid, Social Security exceed $175 trillion. By the government's own admission, we're pretty darn well near $200 trillion in debt. There's no way to pay that off. You bring in Doge, well, at least right now there's not, unless we were to bring all the manufacturing home and grow our way out of it, which would lead to the Great Depression long before we were able to grow. But just for a moment, if I would, and that would be that if we take a look at this massive indebtedness, obviously, and you bring in Doge who points to $2 trillion in reckless spending that we could save, but yet Congress doesn't have the political will to do anything more than $80 billion, and that $80 billion that they agree upon is 38 hours of spending by the government, amounts to nothing. So to Judy's point, in a world where the Treasury bond is losing demand globally, and that's not something that's even debatable. How do you find demand in a country where Trump wants to raise the debt ceiling? There's going to be another $3 trillion deficit. We owe $28 trillion in treasuries that are coming due in 3 years, yet we only take in $5 trillion in tax revenue. He wants to lower taxes, but not lower spending. That's a problem. And even if you don't lower taxes and you keep it at $5 trillion, that's $15 trillion. We owe 28, but that doesn't take into account the $3 trillion this year and whatever we do the next 2 years in deficit spending. The math doesn't add up. So how do you find demand for the Treasury bond in that environment without letting rates go parabolic to attract that demand? If rates do go that high to attract demand, what happens to stocks? What happens to bonds? What happens to real estate? What happens to the banks? At 5%, they started to break. What happens at 10? What happens to the insurance companies who are loaded with treasuries? It's called bang, the Great Reset, everything implodes. So enter Judy Shelton. You reshore all the gold. Oh, wait, didn't we just say we become net importers of gold? I think we did. Over $100 billion that we know of. You contemplate revaluing gold. Where is gold held? Oh, yeah, in the gold revaluation account. That's the name of it. You can't make it up. It's happened 3 times before in this country. Who would that benefit? Well, that would benefit every central bank on the planet, number one. It would also benefit the United States government if indeed it is the entity behind this massive month over month imports of gold at record levels. The largest import ever into the history of the COMEX on the May contract. Who's standing for delivery for almost $9 billion in gold? You put all this stuff together. Okay, Judy, so we peg a 50-year treasury to gold. Why? Well, because what that does, if you do revalue it, now James Rickard says 24,000. He comes up with that number by taking the money supply and dividing it into the gold that hasn't been audited since 53, and he gets this 24,000, which would give the Treasury General Account $6 trillion free and clear. Treasury would issue gold certificates to the Fed, who would print the money out of thin air and give it to the Treasury.
So when you think about everything that's happening right now, from the US dollar's steady erosion to the broader legislative push at the state level for sound money laws, what you're really witnessing is a subtle but historic shift. A grassroots movement is taking shape, slowly but surely reorienting the very foundation of what we understand as wealth. And let me tell you, it's not being led by the Federal Reserve or the Treasury or even Wall Street. It's being led by people like you, people waking up, asking questions, and deciding that keeping your life savings in a fiat system that's rotting from the inside might not be the smartest long-term strategy. Look at what's been going on with Utah. For the first time in recent history, we had a bipartisan unanimous push for sound money laws, only to be vetoed by a governor. Now let me ask you, what kind of world do we live in where bipartisan agreement is treated like a political nuisance? I'll tell you what kind. It's a world where the financial elite are terrified that the average person might actually regain sovereignty over their own money. And why? Because if you opt out of fiat, you're opting out of their system. You're removing the leash. You're saying, no thanks, I'd rather not have my wealth tied to a currency that loses 8% a year, if not more, depending on what CPI basket you want to believe in this week. Now think about the timing. Central banks have bought more gold in the last 2 years than at any point in the last 70. This is not a drill, folks. This is not some anomaly or temporary move. This is a deliberate reallocation of reserves, and it is massive. As of 2023, according to the World Gold Council, central banks accumulated nearly 1,100 tons of gold, a record, and the momentum has not slowed in 2024. The narrative that gold is some outdated pet rock, completely dead, buried, finished. The only people still parroting that line are either dishonest or dangerously uninformed. But let's zoom out a little further. Why is all of this happening now? Why is gold being remonetized quietly behind the scenes while the public is still staring at Nvidia stock prices and wondering when their Bitcoin will 10x again? Because the endgame is near. We are witnessing the tail end of a 50-year experiment in fiat currency management, and the results are in. Spoiler alert, it's not working. You know, one of the biggest myths out there is that inflation is a fluke, that it's caused by supply chain disruptions or war in Ukraine or bad luck. Number inflation is a policy. It's not some unfortunate externality that Jerome Powell accidentally bumped into with his elbow. It's the result of 15 years of artificially suppressed interest rates, quantitative easing, and a treasury that believes deficits no longer matter. In fact, inflation is the only way this debt gets repaid. You think the US is going to pay off $34 trillion in principal? No chance. They're going to inflate it away, and if you're holding cash or treasuries, you're the bag holder. And yet, here's where it gets really interesting. The states, especially red states, are beginning to push back. Not violently, not through protests or secession threats, but through lawmaking, grassroots policy, legislation that says, hey, we think our rainy day fund should hold a little bit of gold. And I love it. It's rational, it's peaceful, and it's exactly what needs to happen. Because if enough states begin to do this, and they hold even just 5 to 10% of their reserves in gold, it sends a powerful message that the dollar may still be legal tender, but it's no longer the only tender. You know who else is paying attention? The banks. And they hate it. They absolutely hate it. Because capital is leaking. Deposits are flowing out. People are waking up and saying, wait a second, my savings account is paying me 1.2%, inflation is 6%, and the Fed has a digital printing press. I'm out. So they buy gold, they buy silver, they look for alternative assets. And this is where the regulatory battles begin. Because trust me, when capital starts to move out of the banking system and into hard assets, into vaults, into private hands, they will try to find ways to stop it. We've already seen hints of it. Janet Yellen's war on privacy with the IRS reporting rules, the push for a central bank digital currency, the attacks on cash, and all of this is wrapped up in some phony narrative about stopping terrorism or crime or tax evasion. But it's not about any of that. It's about control. It's about eliminating your ability to exit the system. Because if you can't exit, you can't resist. And gold is the exit, always has been. Now let's talk about silver. Because while gold is the escape hatch, silver is the rocket fuel. If history is any guide, and it is, once gold gets its footing, silver follows. And it doesn't just follow, it outruns. Think back to the 1970s. Gold went from $35 to $850. Silver went from $1.50 to $50. That's a 33 times return. So if you think silver at $25 is overpriced, you're not paying attention to the bigger picture. What's the bigger picture? Monetary reset, currency debasement, a complete repricing of all tangible assets against a rapidly deteriorating unit of account. And this is not hyperbole, this is arithmetic. And the beauty of it all is that silver is not just a monetary metal, it's industrial. It's used in solar panels, batteries, semiconductors, electric vehicles. We have a supply squeeze baked in regardless of monetary policy. But throw in a currency collapse, now you've got a generational opportunity. I talked to a friend recently, ex-JP Morgan guy, very sharp. He told me that over 70% of the silver bullion held in London is spoken for. Not gone, but allocated. In other words, already claimed by clients. This is not some tinfoil hat theory. These are people with legal title to physical bars sitting in vaults, waiting for delivery. And that's before the next panic hits. Because make no mistake, there will be another panic. It could be another 2008-style credit event. It could be a sovereign debt crisis. It could be a geopolitical shock. But it's coming. The system is too fragile, too leveraged, too dependent on a zero-interest rate world that no longer exists. And when that panic hits, the shift will be violent, not gradual, not polite. You won't be able to call your broker and say, "Hey, I'd like to add some gold to my portfolio." He'll tell you, "Sorry, the market's closed. The spreads are too wide. We're out of stock." Ask anyone who tried to buy physical gold or silver in March of 2020. It was gone. Dealers were posting out of stock signs like it was a Costco in the middle of a hurricane. You want to be ahead of that. And this isn't just about money anymore. It's about trust. It's about sovereignty. It's about what kind of future we want. Because the people pushing CBDCs and ESG scores and technocratic control grids are playing a long game. They want programmable money. They want carbon quotas. They want to decide what you can buy and when and with whom. Gold doesn't play that game. It's permissionless. It's portable. It's eternal. And it scares the hell out of the central planners. So here's the question. Do you want to be reactive or proactive? Do you want to wait until the next bail-in, the next inflation spike, the next legislative overreach? Or do you want to opt out now? Quietly, legally, intelligently. If you're still with me, I think I know your answer. Because here's the thing. We are living through a massive revaluation, not just of assets, but of principles. Sound money, personal freedom, risk management. These are no longer fringe ideas. They are the foundation of resilience in a world gone mad. And that's why I keep saying it's not about getting rich. It's about not getting wiped out. It's about maintaining optionality when the rules change. It's about wealth insurance in the truest sense. So whether it's a few coins in your safe, a few bars in a vault, or just the decision to think differently about what money is and what it should be, start somewhere, because the tide is turning, and you don't want to be the last one on the beach when the wave comes in. Now, if you're in a state where this kind of legislation is being considered, speak up, send a letter, make a call, hell, write a tweet, be part of the solution, because the only thing more powerful than gold is the collective will of a free people demanding a sounder future. And don't let anyone tell you it's too late. That's the defeatist narrative. That's what they want you to believe. But the truth is, it's only just beginning.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.